Hello, everyone. I hope you're all having a great Wednesday. We're very excited to have you here with us for one of our another great seminar with Homestreet Bank. Today we have Jessica Santana with us, who is a loan officer with Homestreet. About a month ago, it seems like maybe it's been longer than a month, we did a whole session on home buying and the market. And so now we're going to go into refinancing, home equity, looking at, where are we at now in the market and what does that mean for those of you who are homeowners and who are looking to potentially refinance or to take out a home equity loan, a line of credit, whatnot. I'm going to go ahead and pass it off to Jessica. And I just want to remind you all, we are recording today, so we will be publishing this video afterwards. You'll get it via email, and it'll also be posted on our website. And then if you have questions throughout, go ahead and throw them in the chat. We'll pause to answer throughout the presentation. And then also at the end, you'll have time to ask your own questions. So if you have something specific, you can save it for the end. Thanks so much, Jessica. I'm going to let you take it away.
You're very welcome. Hello, everybody. It's a pleasure to be here. I'm a loan officer and I've been working for Homestreet Bank for about 8 years. And I have been financing homes for about 23, 24 years, something like that. So I'm very excited to be here and to help you talk about refinancing. It's a very hot topic at the moment. We're experiencing really low interest rates, right? COVID has brought in all kinds of lower interest rates. So the government has been keeping them low artificially, right? To keep the economy going. And so we have experienced a huge number of applications for people who want to refinance. And so it's a hot topic and I'm very excited to talk about it with you today. All right. So let's start first looking at why people refinance. And there are many reasons, but primarily because they want to have a lower monthly payment, right? So if they have an interest rate that's 4.5%, maybe they want to lower that. That will make their monthly payment smaller, and that will mean huge savings long term. And so the main reason people refinance is to lower the interest rate, to lower the monthly payment. Sometimes people have an adjustable interest rate. So that's a rate that's not fixed. That's going to be becoming adjustable and perhaps going up in the future. And they're concerned about that. And so they would rather have a fixed rate. And that's another reason why they would look at refinancing. I'm seeing a lot of people refinancing into a 20-year term mortgage. So let's say that right now they're at 30, they're like looking at, maybe they have lived in their home for 10 years or so, maybe even 5 years. And they're thinking, wow, if I lower my interest rate and shorten the term of the loan, then I can pay my loan off faster. And maybe my monthly payment will not change that much. But long term, it might mean huge savings in terms of interest. So I'm seeing a lot of 20-year term refinances at this time. If you are thinking more aggressively paying off your mortgage, you can also get a 15-year term or a 10-year term. Some people are paying off their mortgage in 10 years. Interest rates are lower the shorter the term of the loan. So a 30-year fixed rate would be higher than a 15-year term. But of course, the monthly payment will be higher if it's a 15-year term because you have less time to pay, right? Another reason why people refinance is to combine a first mortgage with a second mortgage. So maybe you have a home equity line of credit, and usually those have a variable interest rate, and maybe a first mortgage, and having it all combined into one loan is a good reason to refinance. What happens when you combine both of those loans is that the transaction might be considered a cash out refinance, and I'll explain. If you just have one loan and you're trying to just do a rate and term refinance, meaning you just want to go from your 4% rate to say 3%, you're not taking any cash out, then that gives you a lower cost for the refinance when I'm determining what the interest rate will be. But if you are taking equity out of your home, and I'll explain what equity means because I think that's an important topic. If you're taking some equity out to consolidate two loans, so a home equity line of credit that you did not acquire when you bought the home, plus your first mortgage, putting the two together is considered a cash out refinance. And that, of course, will mean a slightly higher cost for that rate, which means a slightly higher interest rate than if you were just refinancing as a rate and term refinance, not taking cash out, okay? So we would just have to look to see, hey, does it make sense to put the two together? And if so, then move forward with that option. A lot of people do want to refinance and use the equity that they have to pay off debts. So maybe they have several credit cards, and those credit cards maybe have a 15% rate or 20% rate, and having those paid off by refinancing, you add it all into just one loan, right, with your mortgage, and that will mean a much lower monthly payment for you and great savings because the credit cards have really high interest rates. Now, I want to caution people about this because in the past, I have seen that people get in a routine of using their equity to recycle debt, and that's not a very good habit, right? You want to have the equity that builds up into your home to be there available for you perhaps in the future when you retire, not necessarily to make it a custom to pay off and recycle debt through use of your equity. So thinking about equity and explaining what this means, some people, when I talk with them about refinancing, they don't really understand what equity is. So let's say you bought your home for $200,000 and that your loan amount was $190,000 when you bought your home. And 5 years later, your home is now worth $250,000. So it's gone from $200,000 to $250,000, right? And then your loan balance, maybe now it's $180,000. So that gap in between $250,000 and $180,000, that's equity, right? When you take equity out to pay debt off or to remodel, you're borrowing that equity, right? You're making your current loan balance bigger by borrowing some of that equity, that's that space, right, between value and loan, and creating a bigger loan amount. So it's not just, oh, take the equity out and have no monthly payment. You're borrowing it, okay? And so that's what the equity is there for. So when you're thinking an equity, a home equity line of credit or a cash out transaction, that's what you're doing. You're pulling some of that equity out. It also is important to understand that when you consolidate debts, maybe your car loan and credit cards, that you do turn that debt into a possible tax deduction, right? Because the interest in your mortgage is currently tax deductible. So that ends up becoming a nice, good benefit as well. All right. Okay, people also pull equity out for home improvements, for college tuition. I'm seeing a lot of people pull equity out for medical reasons, right? The costs, a lot of people who are retired perhaps have some medical expenses and use their equity for that reason. So it's another one of the benefits of home ownership, right? Some people want to refinance to remove mortgage insurance from the monthly payment. So if you bought your home with less than 20% down payment, you ended up with mortgage insurance per month added to your monthly payment. And the rules to remove mortgage insurance are usually that you must make monthly payments for at least 2 years. And then you must show that you have 25% equity. So that value of your home 2 years later in relation to your loan balance 2 years later, you need to show that that's at least 25% equity. And if so, you may be able to not have to refinance, connect with your current lender and just ask them to review your account to remove the mortgage insurance from your monthly payment without having to refinance, okay? Usually you have to pay for an appraisal, and the reason is that you want them to consider the value of your home today, right? So if you need current market value to be used, you need to have an appraiser go out and confirm what that value is, right? So some of you maybe have a really good interest rate and don't want to have to refinance because that is not free, and we're going to talk about that. So maybe just removing mortgage insurance without refinancing could be a good option for you. Or for some people, that's not the case. They haven't been at the home quite 2 years, or they're not quite at 25% equity. Then we could refinance, lower the interest rate, remove mortgage insurance, and have just one loan. And that could mean great savings. All right. So if your whole objective is to just remove mortgage insurance, you might not need to refinance. But to remove the mortgage insurance, only your current lender can help you with that. If you're going to refinance, meaning pay off your current mortgage, create a new one, and have no mortgage insurance, then any lender can help you with that. But to remove mortgage insurance without refinancing, only your current mortgage lender can do that for you, okay? Right. Okay, so consolidating a first mortgage and a second mortgage could mean savings, right? You may be able to, if you currently have a home equity line of credit, you may be able to keep it open and keep it there in second lien position and just refinance the first mortgage that you have. So I'll say this again, let's say you have a first mortgage and a second mortgage, a home equity line of credit. You may be able to just refinance the first and keep the second mortgage there, trailing behind the first mortgage. That's certainly possible. Another option is to put the two together, okay? And so one of the reasons why people want to bring the home equity line of credit together with the first mortgage is that perhaps the home equity line of credit, which usually has a variable interest rate, right, can go up or down. It may be coming to an end of that period when you can draw funds, and they might want to put the two together into just one loan, just to simplify things. All right. Also, the second mortgages, a home equity line of credit, they usually have higher interest rates than the first mortgage. And so putting the two together could mean really great savings. Are there any questions up there?
So far, I've gotten one in, and the question is a reappraisal part of the refinancing process?
That's a really good question. And what I'm seeing a lot of these days is appraisal waivers. So the answer is yes, appraisals are normally required when you refinance. However, if you have quite a bit of equity, you've been in your home for quite a while, I get an application in my system, I run it through this software, okay? And it evaluates credit, value, and it generates, it has a database that determines what the value of the home could be safely. And then if it's comfortable with the value that I input in my system, it will say appraisal waiver. You don't need an appraisal. And that of course saves you about $700 because that's how much an appraisal costs these days. So I'm seeing a lot of those for people who have quite a bit of equity or have been in their home for quite a while. You might not need an appraisal. So the thing is that I can't tell you for sure until there's an actual application and I run it through my system, and then we can find out for sure if you need an appraisal or not. Okay.
Great, thank you. And then just a piggyback question on that is,
Yeah.
can you hire your own appraiser, or do you have to go with the appraiser chosen by the lender?
It's another good question. So this is from the financial crisis time, right? Right after that, the guidelines became really strict. And one of the changes in those guidelines became that the lender could not choose an appraiser of their choice, right? I couldn't just call my friend Randy, who used to appraise homes for me for many, many years, and I want him to come and help me to refinance your home. What happens today, the reason why they stopped that is that they felt like lenders were influencing appraisers and pushing them to bring a specific value that they needed on a home. And so to make it a bit more balanced for owners, homeowners, and buyers, they took that away from the loan officers like me. And so at Homestreet, for example, we have an appraisal order department. And we request an appraisal. They send in the request. They have a list, a pool of appraisers that have been approved by us to work with us. Whomever accepts the job gets the job. I'm not even allowed to speak with that person at all. Once the appraisal is complete, then I get an appraisal report and that's it. There's no contact between that appraiser or me, and that protects you. That way I'm not influencing that appraiser at all. Okay, so you don't get to choose your appraiser either. The lender orders that appraisal. We just cannot pick an appraiser. We kind of have to draw a name. Basically, whomever accepts the job gets it.
All right, thank you.
Uh-huh.
We can move on and then we'll ask some questions later. Yeah.
All right. So reasons not to refinance. I would say that one main thing I want you guys to consider is that, you know, those closing costs you had when you bought the home, you're going to have all of those again when you refinance. So refinancing is not free. Escrow, title insurance, appraisal, credit report, all of those fees are going to be, they're going to come up again. And you're going to have the choice of rolling them into your loan, so financing them into the loan, or paying them with cash out of pocket. That's up to you. Most people roll it into the loan. So that means that you're increasing your current mortgage balance, right? Because you're going to finance all these costs. And so I want to caution people not to get too excited about paying extra to buy the rate down, because you're financing it, right? You don't have to write a check and then, ooh, 2.875 sounds better than 3, but not cost me another $3,000, right? Roll it into the loan. I think it's important to think of, okay, these are the closing costs. This is my current rate. This is the interest rate I'm going to be refinancing into. How long does it take me to break even? So let's say I'm saving $200 a month, right? If I save $200 a month and I have $6,000 worth in costs, how many years does it take for me to recover that cost so that I break even? And then after that, it's really savings, right? And so it's one of those things that you really want to talk with your loan officer about when you're looking at refinancing. Yes, I'm saving money, but how long is it going to take me to recover the cost? Even though it's financed and you don't really feel it in your pocket, your loan amount has become bigger. And so we want to just be conscious of that. All right. If your loan amount is really small, for example, let's say you owe 100,000. Well, refinancing, by looking at adding the closing costs into your loan, you're going to be feeling like the closing costs are really big, right? Because just an appraisal is $700. $700 in relation to $100,000 is a huge amount, right? Whereas if I'm refinancing, I don't know, an $800,000 home, $700 fee for an appraisal is a small amount, right? So if your loan amount is smaller, you're going to feel like the closing cost will be a bigger portion of that loan amount, and it might make it just not worthwhile for you to refinance. Okay, you may want to just keep your loan as it is and keep going. Shorter time. one of the main questions we ask is, okay, you want to refinance, great. Are you considering selling and buying something else in the near future? Because if not, if you are thinking about selling, then why refinance? You're going to have all these closing costs. You might not be in the home long enough to recover the costs and then really reap the benefits of refinancing, right? And so that's one really good question, okay? If you're not going to be there long enough, then just don't refinance. And then the other one is term extensions. Usually, if you have been in your home for 10 years or so, and you have a 30-year mortgage, and then you start another 30-year mortgage, that means you're extending the term, right? You were already there for 10, and now you're starting another 30. And so if you have been there for at least 10 years, you may want to consider a 20-year term, or maybe even 15, so that you do remember that you want to pay off that mortgage so that in the future you don't have a mortgage payment, okay? So shortening the term of the loan is an important thing to remember. All right, we're going to move on to the next slide. Any questions there?
Yeah, so we've had a few come up. So
Okay.
one is, so if you're in a circumstance where you own two homes, and so you have two mortgages, and then you also have a home equity line of credit, is it so first part of that question is, does that mean that you kind of technically have three mortgages because of that home equity line of credit?
Mm-hmm.
Okay, and then so because of that, is it possible to combine all three of those into one single mortgage?
Well, so that's a very good question, and it depends. So when you refinance your home and you're taking cash out, you can go up to, normally, up to 80% of the value of the home. So let's say that you have two homes and one owes only 100,000 and maybe the other one owes, oh, I don't know, 300,000. But this one, which is your primary residence, okay, that's the main tricky part here. Being able to refinance your primary residence, meaning that's the home you live in, that's where you can take up to 80% of the value of the home as cash out, okay? And if you're gonna do that, then it's gonna give you the most equity available. Whereas, let's say that this other property that you have is rented out, then that's an investment property, right? And on that one, you cannot take 80% of the equity out. You're going to be limited to 60 or 70% of the value of the home. So you're not going to have as much equity to use to consolidate mortgages, right? So let's go back. Let's say that this is my primary residence and I owe 200,000. And then I have this other mortgage that's 100,000 of this other property. But the amount, the value of my current home, let's say that it's 800,000. I have plenty of equity to put the two together and create just one loan, right? And so the answer to that question is it's possible, but it depends on how much equity you have. If there's not
All right,
enough
that makes
equity in there to
sense.
put the two together, then that's not going to work out.
Mm-hmm.
Okay, and so
And
the
then this,
limits as to how much of a refinance, how much of a loan you can get when you're refinancing depends on whether it's your primary residence, the home you live in, or whether it's a rental property. And the other thing is that if you're refinancing an investment property, then the interest rates are higher for those homes than it is for a home that you currently live in.
all
Does
right,
that
thank
answer the
you.
question?
Yeah, it does. There was just one more kind of piggyback on that. Does
Okay.
it make sense to refinance at this time, if you're pretty sure you want to sell your house within the next year?
I wouldn't. If
Okay,
you're going to sell your home within the next 12 months, I wouldn't.
all right.
Yeah, and something, maybe this prompts us to, let me see if it's this next slide. Yeah, there's something called no cost refinancing, right? And then we're like, oh, really? You can refinance with no cost. And here's how it works, right? Because we all know that there's nothing free in this world, right? And so let's say that my current interest rate is 3%, okay, on the market. And that in order to give you a no cost refinance loan, I have to increase my interest rate. Maybe that will mean 3.5% rate. What's in between 3 and 3.5, that increase generates a yield or a credit or a rebate that I'm able to use to cover the closing costs for you. So it doesn't mean that it's free. It's just that it's being covered by this increase in the rate so that then there are no closing costs on your estimate, right? And so it may make sense to do it that way, especially if you're not going to be living in the home for maybe more than a year. If even at 3.5%, it still makes sense because you break even right away, you have no costs, then you don't have to be there long enough to recover them, right? And then maybe that makes sense. But if that's not the case, and by increasing the rate, you no longer save, then just don't refinance. If you're going to be selling within the next 12 months, just let it go. Okay, because if you're not doing the no cost refinance, you're spending your equity to refinance. And that could have been money that you could have taken with you when you sold. So just don't do that. Okay.
Thank you. So I have two more questions.
Okay.
One is I'm 15 years into my 30-year mortgage. My interest rate is at 4+%, but knowing that I pay less on interest in a later part of the loan, is it worth looking into refinancing to a 15-year? Is there a calculator to take accounts of the incurred fees, etc.?
Yeah. So that's something you want to get together with your loan officer with and evaluate. If you're at 4 point something and you could lower the interest rate to say 2.7 on a 15-year term, it's going to save you a lot of money because you're reducing the interest rate. So just the interest portion of the loan is going to make a big difference. However, what's important about your question is that you're right. In as time goes on, right? Here's your mortgage. You're just starting, just got the home. This much goes to principal from your monthly payment, and this much goes to interest, right? And then every month, a little bit more goes to principal, a little bit less to interest. So as years progress, you have a lot more going towards principal and less towards interest. So if you've had the home for 15 years, then we would want to evaluate, okay, how much is going to go to principal and how much is going to go to interest when we refinance to make sure that it still makes sense. But if you're in the fours, going into a 2 point something percent interest rate, sounds to me like would make sense. We would have to spend a little bit of time making sure that that's the case. Okay.
All right, and then that last question is just kind of picking off talking about the value of your primary residence. So when you were talking earlier about 80% of the value of your primary residence, do you define that primary residence value as your appraised value minus what you still owe on the loan, or is the primary residence value just the appraised value?
Yeah. Okay. So when you're going to refinance, you're likely going to need an appraisal, right? But even if you don't, let's say that you bought your home for 200,000 and that now that home is 300,000. Okay, current market value. That's what we're going to use, 300,000. And then you take 80% of that. Okay, and that's how big your loan could be. So in that 80%, let's say that you only owe 100,000. So the difference between 80% and the 100,000 is how much cash you could get out of the loan. Okay, I'll make it a little simpler. Let's say that it's market value is 100,000. Okay, and $80,000 would be 80%. That's the maximum loan amount you could get, right? If you owe only 60, but you get an $80,000 loan, that means you could get that $20,000 difference. That's how much cash you could get out, right? So it's 80% of the market value of the home.
All right, thank you. That's all the questions for now, so we can continue on.
Okay, awesome. So then it says, so the no closing cost is the one that we talked about, right? You increase the interest rate, there's no closing costs, and then you break even faster. So what you want to do is, it says here, savings versus costs, right? How long you plan to stay in the home, and what long term should you use. And so I think the most important thing to do is to just have a thorough evaluation of your current loan, your plans for the future, and how much it's going to cost you. Because it's not just, oh, what's the interest rate? It's how much is that interest rate going to cost me? That makes a big difference. So common misconceptions of playing the rate game. And so that's what I mean, right? You end up, oh, but is it 2.8 or is it 2.7? Oh my God, but is it costing you $10,000 just to lower that interest rate? And it might not make sense. It might take you 4.5 years just to recover the costs. And then it's really savings, because otherwise you're prepaying your own savings and then it makes no sense. So you want to make sure you evaluate and figure out, okay, how long does it take me to break even? And then from there, determine if you want to move forward. All right. Let me see what else is over here. Okay. So before I go into the next slide, I want to just mention that normally what I do is schedule a 30-minute phone consultation with my clients. So people send emails all the time saying, hey, I would like to refinance. What's your current rate? And interest rates depend on the value of your home, your credit score, if it's a primary residence or not, if you're taking equity out, if you have a first and second mortgage or just one. All of that is going to impact the rate. And so the answer is never, this is the rate, right? It's always, it depends. So scheduling something over the phone with a loan officer is important so that you can evaluate the loan process and you can really understand how refinances work. What I find in these conversations is that there's a misconception as to the payoff amount in relation to the principal balance of your mortgage, okay? So you look at your mortgage statement and it says you owe 100,000 principal balance due, right? That's not the payoff amount. To that principal balance, they're going to add interest to that. So the figure is going to be higher. The reason is that when you bought your home, for example, you bought it in December. December, it closed the transaction. January, there was no monthly payment until February 1st. And that's because February pays for January. When you look at your principal balance on your mortgage, maybe you sent your monthly payment for September already, but that covered August. And so they're going to add interest for September, which is when the loan is getting paid off. Okay, so number one, the principal balance on your mortgage is not the payoff quote. Okay, number two, escrow. You probably have, if taxes and insurance are included in your monthly payment, you probably have a current escrow account. That's where taxes and insurance accumulate, so that when the tax bill and the insurance bills come, we, the lender, go to those accounts, pull money out, and pay the county for you, right? So when you pay off that mortgage, because you're getting a new one, the balance from that escrow account is refunded to you within 30 days after we close this mortgage, okay? But in the new mortgage, I have to create a new reserve account. So I have to collect enough money for taxes and insurance for the new loan. Okay, so that's going to increase the amount of money that gets financed. When I look at how long does it take for you to break even and recover the closing costs, I don't consider this new tax and insurance account in my calculation, because it's money, that's money that we are using to pay taxes on your behalf. It's not really a cost of the loan. The closing costs, like appraisal, title, escrow, those I use to determine how long it takes you to break even. Okay. And then when you refinance, let's say right now it's taking us about 75 days to close a transaction. It's really, really busy. The purchase market is crazy busy. Purchases are taking priority, right? And so refinances just take a little longer. You guys are in your home, buyers need to move in. So they have to go first, right? Okay. Let's say we close your transaction in November. In November, we close the transaction, let's say the 15th of November. Interest from the 15th of November through the end of that month will be prepaid interest included in your closing costs. But then December, there's no mortgage payment until January 1st. Just like when you bought the home, right? And that's because January pays for December. So it's gonna feel like another free month. It's not free, we all know that, but it's really gonna make a little bit of an impact as well. Okay, let me see. Yeah, that's what I wanted to help you guys explain, to understand, sorry. So having this evaluation, helping you to do a 30-minute phone consultation. Okay, what's the rate? What are the closing costs? What's my monthly payment gonna be? How long does it take me to break even is really important, okay? And what I find useful is to have my clients, if the mortgage is not with Homestreet, I ask them to send to me a copy of their current mortgage statement. That way, when I'm creating a cost estimate for them, I have accurate information. I'll be able to see how much you owe, taxes, home insurance, all right? And so one form that is very useful if you're thinking, I would like to get a quote for refinancing, is to complete this form that you see now in the presentation. It's important for you to show what your current balance is. If you have more than one mortgage, how much are the property taxes? How much is your homeowner's insurance? And then I don't see that listed here, but is this your primary residence? I mean, do you live in it or is it a rental, right? Because that's going to make a big difference. And then the type of property makes a difference too. Is it a house or is it a condo, right? We will probably look at Zillow or Redfin for estimated value of the home. You probably want to take a look at those websites as well so that you have a general idea as to how much your home is worth. It doesn't mean that's the value of the home. It's just it's a free starting point, right? It gives you an idea as to kind of where the values are, okay? So anyway, if you look at this form, you can let us know, do you need cash back? What is it that you're trying to accomplish? What term, 20 years, 30 years, 15, so that we can have enough information to help you with some options. If you provide this information to us within 48 hours, somebody will get back with you and help you with a quote. If you would rather have a phone consultation, then you can definitely reach out to me or to one of the loan officers in our team, and we can certainly help you out. Okay. Any other questions?
Yeah, so I have another question. It's a little bit long, so hang in with me here.
Okay.
So it says, I am 3 years into a 30-year mortgage. I considered refinancing to a 20-year mortgage to reduce interest from 4.125% to under 3% without paying rising approximately $200 per payment. However, I believe rather than refinancing, I could instead just put an additional $200 toward the principal and reduce the term of my 30-year loan to close to 20 years by paying off early and simultaneously reduce overall interest paid.
Yeah.
Is that correct? What is this person missing?
Yeah.
And if you miss
So
any of that, you can open it in the chat too.
yeah, no problem. So I agree. I mean, it's really important to remember that you can always just send extra towards principal, right? That's going to make the loan amount smaller every month, and it's going to help you pay the loan off faster without refinancing. So if instead of paying the loan off in 30 years, you pay it off in 20, it's saving you thousands of dollars in interest, right? However, if you're doing that at a 4.125% rate, instead of doing that at a 2.875% rate, then that difference in interest rate could mean thousands of dollars in savings in the long term, right? And so as long as you plan to stay in the home long term, and by long term, I mean at least 5 years, then it might make more sense for you to refinance into a lower interest rate and shorten the term of the loan because the overall cost of the loan may be lower. Okay, it just needs to be evaluated.
All right, thanks. I
Mhm.
have two more questions. One is, are there any closing credits for refinancing with Homestreet for UW employees?
Oh God, thank you for asking that. I forgot about this. Okay, so of course, UW employees receive a credit towards closing costs, and it's equal to a half of 1% of the loan amount. So if your loan amount is 400,000, it's a $2,000 credit. If your loan amount is 500,000, it's a $2,500 credit. So it's a half of 1% of the loan amount, which is applied as a credit towards your closing costs. I have to say also that for those of you who are thinking of buying in the future, you get a credit towards closing costs when you purchase a home as well. And your benefits for refinancing or purchasing extend to your immediate family. So it's mom, dad, brother, sister. And a lot of people don't know that. Okay.
All right, thank you. And then one other question is, can you just talk a little bit about what you've heard or what you're aware of with a potential adverse market fee that could be added in the future?
Yeah. So this is a Fannie Mae, Freddie Mac fee, right? They're saying, okay, for refinances starting 2021, they're increasing their fee by a 0.5%, right? And so the main concern for us as lenders is, wow, that increased amount of cost is something that we cannot bear, right? Lenders already are so streamed in terms of how much money they can make. So having this increase in fee could definitely mean some lenders maybe even going out of business, right? And so there's a lot of requests for those of us in the mortgage industry to um, sign, to vote, right, against that particular proposal. Um, and so we are working to stop that from happening, especially now when we are so busy just trying to help people lower their monthly payments, especially during these COVID times. But what is true is that if it does if it becomes effective, then the cost ends up getting transferred on to the buyer, to the consumer, right? And so I think it's going to end up impacting the cost of refinancing for homeowners in the future, just because lenders can honestly just not take that on. But that's how it tends to be in general in all kinds of industries, right? Costs go up and it ends up getting transferred on to the consumer. And so we all end up paying more in the long term. But it's not 100% sure that that is something that's going to be passed. It's up for vote. And so we're hoping that it does not happen.
All right, thank you. And we have two more questions, and then I'm going to go ahead and open it up if anyone would like to. You can raise your hand on the over in the participant bar so that you can ask your own question, but I'll keep just going down the chat for now. If anyone has a question, go ahead and raise your hand now, and I'll keep an eye out for those hands. All right, so the first one is, it's from Anne Marie. It says, our home is a duplex, but we use it as a single family home. A recent appraisal could not find recent comps or nearby comps, so the value is vastly under what our realtor told us she could sell the home for. We want to refi because we want to stay in the home, but if we can't get an appropriate appraisal based on being classified as a duplex, what can we do?
Yeah. Unfortunately, the way you arrive at value when you appraise a property is by looking at homes that are similar in size and characteristics that have sold in the last 90 days that are within a 3-mile radius, right? And if there are not that many duplexes in the area, then that definitely impacts the value of your home, because then appraisers are going to be having to make adjustments, and lower, and it does end up lowering the value of your home. Let's say that you have a home that's similar, right, like 2 blocks away, then they would just use the value of that home as a perfect comparable. But if that's not existent in the area, at least at this time, right, things have not sold that are similar in the last 90 days, it's going to definitely impact the value of your home. And there's really nothing you can do about it. The other thing I want to say is that the value of your home for purposes of selling a property versus for purposes of refinancing is a little bit different. Appraisers look at past values, right? What they have, most recent sales, what they closed at. Whereas sales, they look at recent homes that recently sold. However, buyers right now in a very competitive market are, overbidding each other, and the highest price wins, right? So that means prices get pushed up. You might end up with a much higher price than you thought of when you sold your home at this time because it's so competitive. But when an appraiser looks at value, they're not looking at possible buyers who are going to be competing. They look at what homes sold for. So that pushes, that kind of tends to provide you with a lower value than if you're thinking about selling.
All right, thank you. And this
Mhm.
next question from Sarah is, I took a break between jobs, but am now at UW. Does that time off impact my ability to refinance?
Oh, I'm sorry. So took time off from work.
Yeah,
But
but just between jobs.
okay.
And would having that time off, like kind of on your record, does that show and would that impact your ability to refinance?
So any gaps of employment need to be explained. If you just say, I took time off for this time, for this reason, and as long as it makes sense what the previous job was in relation to what you do now, then you should be okay. We're seeing a lot of people who were furloughed, right? Or people who, because of COVID, were not able to work, but now they're back to work. And so we need explanations, a lot of emailed explanations, so that when we look at an application, we can understand why maybe the year-to-date income is lower. And that's because for a period of time you were not working. So I think an explanation in that case should be okay.
All right, thank you. And then this next question from Dana is, so adverse market fee is potentially an argument for refinancing before 2021?
So I believe that it's up for vote. It's not final. It has not, a decision has not been finalized regarding whether this is going to be in effect or not. There is talk about it being effective in 2021 and about the impact it will have in consumers and in lenders. But it's not effective right now. And I know that they were encouraging lenders to petition against that from happening. So my understanding is that it hasn't been approved yet.
All right. And the next question from Anthony is, what would you suggest if we are currently looking to make home improvements, but we just refinanced in March and didn't add it to the amount of the loan at that time? I don't think it would be wise to attempt another refinance.
Yeah. So in refinancing, the rule of thumb is you want to save about 1% in the interest rate, right? So if you just refinanced, you had all these closing costs rolled into your loan. Doing it again is likely not the best option. A home equity line of credit becomes then a good second option, right? but home equity lines of credit are a second mortgage. And home equity line of credit right now, they're limited only up to 60% of the value of the home. So if you don't have quite a bit of equity in your home, you might not be able to get a home equity line of credit, which is a second mortgage in your property. I want to say that home equity lines of credit prior to COVID, we could go up to 90% of the value of the home and take cash out for improvements or for other purposes. But since COVID, things have tightened up, right? There's a bit of uncertainty out there. And so guidelines are tighter. And so on home equity lines of credit on a primary residence, we can only go up to 60% of the value of the home at this time. What's nice about a home equity line of credit is that they have no closing costs, right? And so the lender pays for the cost for you. It works like a credit card in that you only make monthly payments on the balance you use. So if it's a $50,000 credit line, but you only use $9,000, then your monthly payment is only based on the $9,000 you use. However, home equity lines of credit have a variable rate. They're based on Prime, the index that gets published in the Wall Street Journal, and that rate varies, right? When the federal government stimulates the economy up or down, Prime, the index, is what they use. So it moves slowly because it can really impact the economy, but it's not a fixed rate. And so home equity line of credit is a good option for short-term projects, something that, yes, I'm gonna fix my home, finance these repairs, and then quickly pay that loan back, and then maybe keep that loan open as an emergency fund or as funds for other projects that may come up in the future, but you wanna pay those down quickly. It's not the kind of loan you wanna keep for 10 years, for example, simply because the rates can change. So if you refinanced already, a home equity line of credit might be another good option for you.
All right, thank you. The next question from Brian is, will the adverse market fee potentially, if it happens, will that apply to jumbo loans? And what is the loan amount cutoff for a jumbo loan?
So jumbo loans right now in King and Snohomish County is $741,750 or higher. And my guess is that the adverse market fee will apply to any mortgage out there, but I'm honestly just not sure. I would just, to be safe, say, yep. I think all of us are going to be impacted, unfortunately, but there's still a chance it might not pass.
All right, the next question from Elizabeth is, I'm interested in a potential DADU in our back lot. Anything I should be aware of about mortgage process for building this new structure / home?
Wow, that's an interesting question. So you're referring to a mother-in-law unit, right? An ADU.
Yeah, accessory dwelling unit.
Mm-hmm. And so first, you want to just make sure that you do it with a permit, right? That your home is actually zoned for that you can get a permit for it. And then it should still be considered just a primary residence with a mother-in-law unit, and that should be fine. Appraisals tend to cost a little bit more when there's an ADU, a mother-in-law unit, attached to the property. Construction right now, I'm not sure if it needs a permit or not as far as expanding the perimeter of your home, but those permits are taking quite a while at this time in Seattle. So hopefully you have a good architect and designer with all the permits lined up, and do your research, right? Just to make sure that that's allowed.
Great, thank you. So I'm not seeing any more questions come in the chat. We have about 5 minutes left. No hands are being raised over on the participant bar, so I'll give maybe just a little bit of virtual time if there's any typing going on out there.
Yeah.
And
Yeah.
Jessica, do you want to give people your contact information and maybe talk a little bit also just about how to get in contact with Homestreet if people are intrigued and want to take this a step further?
Yeah, yeah, absolutely. So I'm going to go to the next um, page. We talked already about the benefits to UW employees, whether they're buying or refinancing. And then you'll see my contact information here. You can either reach me by email or by phone. And what I recommend is that you schedule a 30-minute phone consultation if that's what you'd like to do with me. You can also just go ahead and apply directly. The website is right here listed if you want to just work with anyone from our team. If you want to complete that form, it's also, I think you have it, Anna, right, as an attachment.
I do, yeah. So we can
Yeah,
send, we'll send the slides and the form as well to everyone by the
okay,
end of the week. And then in the coming weeks, we'll work on publishing the video as well.
okay, okay, great. So what we'll do is just, if you have that form, you can either send it to that email address that you see, or you can send it directly to my email. Just give yourself a little bit of time for responding, right? And for scheduling those consultations. Just keep in mind that these are busy times. So just be a little bit patient, but we will be super happy to help any of you.
Thank you, Jessica. I also just wanted to check. So if someone were interested in refinancing with HomeStreet and getting that credit for UW employees, can they do that if they reach out to you directly, or do they have to go through the UW portal
No, they can
for the
reach out
UW
to me
credit?
directly. Yeah,
Okay,
yeah,
great.
yeah, of course, sure. If they go through the UW portal, then they're going to be able to work with anyone within our team. We have different loan officers, not just myself. If they want to work directly with me, then they can just reach out to me directly.
Wonderful.
No problem.
Thank you.
Yeah.
And then I just had, there was a raised hand and then a piggyback off of an earlier question. So I'm going to read those off while we have a few
Okay.
more minutes here.
Okay, good.
And so this is specifically regarding that mother-in-law potential unit. The question is, if it's a detached unit separate from the primary structure, would adding that in, would the mortgage be separate, or would that be added typically to your primary residence mortgage?
Hmm. So even if it's not attached to the home, it's just one loan financing one property. If it's two properties, right? If it's subdivided, you have two different tax parcels, then you're creating a duplex, right? You're creating two different properties, and that's not what you're doing at all. I think you're just having a mother-in-law not attached to the primary residence. It shouldn't impact, it should just still all be under one loan. So if you're financing the construction, maybe you have a second mortgage, that's different. Putting it all together as a refinance, it should all be still under just one property, one single family residence with a mother-in-law unit, whether it's attached or not.
All
You
right,
just
makes
want to be
sense.
careful. I mean, usually mother-in-laws have a little kitchenette. It's not necessarily meant to be, two full-blown kitchens with completely, you don't want it to be two separate units that are considered, um, then it's not a mother-in-law, right? It's supposed to be a place where um, it's not meant for it to be a full rental separate apartment, right? It's supposed to be part of your home as a mother-in-law unit. It's a little bit different.
All right, thank you. And I'm going to go ahead and invite Andrea to go ahead and unmute yourself and go ahead and read off your question.
Thank you. I just was trying to wrap my head. I know you mentioned about the, in response to somebody else, about the HELOC being a potentially a good choice if you have a shorter term project. Can you just say a little more if you're wanting to do a bigger kind of remodel of the house, something not global structure, but just the insides, kind of updating that kind of a thing. Choosing a HELOC over doing a refinance. Some general comments, like a cash out, like looking at the cash out versus doing a HELOC, what would be the benefits, pros and cons, one way or the other?
Yeah. Well, so the pro of the HELOC is that you have no closing costs at all, right? And that the construction or the remodel inside your home might take some time. And so being able to just pay interest on what you use versus the full amount that you borrowed is a convenience, right? You only take 10,000 first, pay only on that. And then as it increases and your project progresses, you draw a bit more. You also then have the option of refinancing later and consolidating the two into one loan. But then based on the higher market value, because I'm assuming that with this project, your home will be worth more. And so more of the equity will be available possibly to consolidate both mortgages. And so I think that will be a good option for you. So a home equity line of credit, just remember it's only up to 60% of the value right now. I don't know if that is something that would work for you. But if not, go ahead.
Yeah, we are 18 years into our house, and so we owe about 120, and I think our value is about 500. So we're not really worried about equity. It just needs to be updated. It's 1980 house. So yeah, but trying to kind of find our way through which options make the most sense.
Yeah, I mean, if you know already for sure the amount of money you're going to use on the to remodel, and you want just one loan, take advantage of the low interest rates, then just go ahead and refinance, take cash out, do just one transaction and be done.
Okay.
If you're the one who just recently refinanced, right?
Yeah.
Is that you? Okay.
No, it's not. That was somebody else.
Okay. So then in your case, I would say go ahead and see if just one loan cash out makes sense for you instead of a home equity line of credit, depending on how much money you plan to withdraw.
Sure. And then is there there's a tax difference in what interest is tax deductible, or did all of that kind of stuff change in the last year with the tax overhaul?
Oh, Andrea, so tax.
That's a whole nother session probably. So.
I know, tax question. So
okay.
My understanding is that the interest on your first mortgage was deductible now.
Okay.
The home equity line of credit is not, but then it depends on the loan amounts. And
okay.
It changes yearly. So I would say that's an accountant's question.
Okay. Thank you. I appreciate the general commentary though. I appreciate it.
Yeah, you're welcome.
All right, thank you both. We're going to go ahead and close, but I just had one last question from Rick. I wanted to make sure we got in. So thanks for sticking around, Rick. I see you're still here. And Rick's question is just to clarify and be sure, in a cash out refi, there's no restriction with what you use the cash for? Like you could take that cash out and put it towards a project on a different house?
Yep, so it can be a project towards a different house. It could be, and that depends. Do you mean you're going to remodel another house? The main restriction is if there's cash out for the purpose of starting a new business. Like then it becomes commercial and that's a no-no, right? But for the most part, it could be to debt consolidate, to remodel a property. Maybe you have two properties and you pull equity out of one to remodel property B, that's no problem. If you're pulling equity out of this one to buy another home, then the question becomes, are you going to live in this one or are you going to live in this one, right? Which one is the primary residence? And that may change the ball game. But if you own two homes and you pull equity out of this one to remodel this one, it's okay. It's no problem.
All right. Thank you so much, Jessica. And thanks everyone who stuck around. We're just after 1 o'clock, so we're going to go ahead and close. And we're so appreciative of you being here and we can't wait to have you back. We always learn so much.
Thank you. Thank you, everybody, so much. Stay healthy out there.
Absolutely.
Right? I know. I hope the smoke goes away soon.
Sometime soon.
Yeah.
All right, everyone.
All right. Thank you.
We'll see you at another time and we'll be in your email inboxes. All right. Bye.
Thanks so much, Anna. Bye.